Hello, it's Doc Severson for the ReadySetCrypto OMNIA newsletter market update for Sunday, the 10th of May. Happy Mother's Day for all of you mothers out there. Okay, we have a little bit of activity here, don't we? With about 10 hours to go. I'm cutting this late Sunday morning where I am. About 10 hours to go with this candle. We have had a lot of movement over the last 12 hours or so. If we go down to the 12-minute chart, we can see that we had a little meltdown that happened here from about 9,800 all the way down to somewhere in the lower, where is this? The lower 8,000s or so, close to 8,000. So big volume, a lot of liquidations. Of course, Twitter is all on fire about how everybody got wrecked. And this is just a pattern that goes back and forth across the board here, doesn't it? If we look at this, we see that really since the end of April, we've been going in a parabolic fashion. And here we get the old FOMO kicking in where people just can't stand it, right? And I've mentioned this many, many times, is that the actual emotional pain that you go through sitting on the sidelines, watching a chart run away without you being on board is actually greater than if you had just taken a stop loss on a normal position. Stop loss on a normal position. Hey, didn't work out. Okay, I'll try it again next time. Whereas if you see a market running away from you, the train has left the station and you're just sitting there, you're not on board, it can be extremely nerve-wracking. And I think a lot of you perhaps went through this over the last couple of weeks and said, hey, should I get in now? What about now? What about now? Where's the pullback going to come? Okay, and the pullback shows up and then everybody backs away and says, oh, I don't want anything to do with that. It's a completely different situation. At least that's the way that the brain interprets it, right? We do this all the time. We see price running away, and then if we somehow stay on top of it and don't submit to the FOMO, then we puff out our chest and we say, oh, wait till the next pullback. I'm going to be all in on this. And then the pullback shows up and we're standing off to the side saying, well, no, this doesn't feel right. I'm going to wait till the next pullback, or I want it to go back a little further. Or we're going to do some kind of history down here about the halving and say, well, there's a historical pattern that says that price always dumps after the halving. And, part of what I want to talk about today is that what happened during the last halving. So let's go back in time and see if there's any historical precedent to this. All right, I've zoomed into the middle of 2016. So this is about, 4 years ago in July of 2016, and we had sort of a pre-halving rally. So this occurred a couple of months before this. And quite honestly, this is before most people really knew what Bitcoin was all about. Many, many fewer people were involved with this versus now. So we started to rally on anticipation of the halving. There's no doubt behind this. The volume kicked in. And then what do we see? We see the price drop from about 780 all the way down to 540. So about a 31% haircut, at least intraday. And then we recovered a little bit. And then we had a second dump down here. And I don't know if there was any news behind this particular dump, but there is a pattern of this, of getting everybody excited about something, and then the floor opens up. Now, after this, though, you can start to see that really things kicked off into that massive rally into 2017. But it was a little bit painful in the beginning. So the first people that got the idea that the halving was going to be something big, if they jumped in at this point, they got punished. Ultimately, they got punished from this. Now, the actual halving date, nothing really happened. It was the 9th of July. You can see that this is a very just small range candle, not much going on. Actually, it rallied after that. But it was this dump that really, I think, shook off a lot of folks. And there was certainly a lot of capitulation at this point, and then only to see the price rise without them. And we go through the same thing again and again. Every time that we see one of these FOMO moves, we eventually have what's called the hairy back behind it. So for every FOMO move, we will have a hairy back to this, and then ultimately into the biggest one of them all. So looking at today, this actually looks fairly normal. Now pulling out to the weekly chart, let's take a secondary look at this from the weekly chart perspective. Again, I realize I've got a lot of trend lines on here junking things up, but we can see that this is just another swing off the bottom up to a lower high, and that this goes along with what I've been saying the last couple of weeks, is that, okay, it's great if we decide to set a higher high, but it really is useless until we set a higher low. And that's really what needs to happen next, is that higher low needs to establish itself, needs to happen on some negative news, on some bad price action, on people getting disappointed, because we've got to set up the bearish sentiment. We have to create that atmosphere of skepticism and negativity, which over leverages the bears, because right now you got to bet that they are super confident, especially after shorting the highs at 10,000, just above 10,000. They all jumped in. And of course, it's a weekend move, which means that the big boys are not involved for whatever their level, even though they do not, the CME does not drive the majority of volume in cryptocurrency. So everybody gets all excited and upset about gaps that are created by the CME, but quite honestly, they do not drive the majority of options volume. Now, what's going to be interesting, and I've brought up a chart of Thinkorswim over here because they do chart the BTC. Remember that the CME writes futures contracts on Bitcoin. These are the ones that are the big institutional ones that are the 5 BTC per contract is what they're leveraging. And so these are generally institutional contracts. Most retail traders just do not have the capital to be able to leverage that. Maybe they did that on purpose. Who knows? But anyway, you can see this ended up trading on Friday. The BTC contract traded near the recent highs at about 10,000, and that's where they stopped trading. And of course, they do not trade on Saturday, and they don't trade on Sunday until about 6 o'clock Eastern time. So these will start to light up in about 7.5 hours from when I'm recording this. And they're going to open up with a pretty hefty gap to the downside. So they're going to be pricing in somewhere around this level. So there's going to be a fair amount of gap that happened at this point. Certainly leading some to be excessively long and underwater that bought in near the highs on Friday. So for those of you that buy into the gap theory, we'll watch this gap and see how it goes going forward, but there may be a good chance that this gap does get filled in time. Again, one of these weekend gaps. That happens because the CME does not trade over the weekends. Okay, back to our weekly chart. So if we want a higher low to show up, where do we want this to show up? Or where can we anticipate this higher low to show up? This is where we've gone to the fibs. So let's get rid of the volume here just to clean things up. Let's go over to our fib retracements and write those up. So let's go to fibs, fib retracements. We'll start at the very bottom of the crash back in the 13th of March, take it all the way up to the highs. And you can see that I've got these yellow lines, which I've already marked on here, that represent the 38.2, 50%, and 61.8% retracements. So let's get rid of the fibs. They've done their job. So we can anticipate maybe, and I like this one here, the 38.2 retracement of the entire swing coming down to about the breakout level. So really things were sort of choppy in this level until we started to break out on this significant candle above 77.50. A retest of this from above would generate the negativity required to shift everything towards the bearish sentiment and maybe give the institutional bulls an opening to push this thing higher. And this would create maybe, just maybe, our higher low that we're looking for. Otherwise, we might be looking for the 50% retracement at 7,000, or maybe even as far down as the 61.8% retracement at 62.50. So how do we trade this? Well, there's a couple of ways that we can do this. We can simply take a pullback entry or a confirmed bounce from this confluence level here at 38.2, 77.50. We can just simply try to go long there with either spot or leverage currency. If you want to go for a deeper entry, you can sit there with your limit order around 7,000 and see if a 50% fib would fill, or maybe even as far down as this. Now, there is a different way to handle this, though, which uses options. And this is going to be an almost perfect scenario where we want to be selling puts basically to get paid for that pullback. There's a couple of different ways that I could play this. First of all, I could go with something like Deribit, which is cash settled and unavailable for U.S. customers. So I'm just going to bring this up as an example, but I can't take this trade. What we can do is go out to 46 days is pretty close to where we'd be optimal. Usually somewhere between 40 and 50 days is really good for this. And we can look at like what's going to provide us with the target return that we want. So in other words, we look at these strike prices and we say, where would I want to be buying this? Now you could say 2,500. Yeah, I don't want to buy it until it gets down to 2,500. Well, you're not going to get paid much for this. You maybe get per contract. So for a whole contract, you're going to get maybe a 1% return. You're going to get like $25 of credit for that. Yeah, not so good. Okay, so maybe a little bit more aggressive, maybe 4,000, which is close to the recent lows on the crash. Again, still not that much. Maybe you'd get $90 for something like that, about 2.5% return. Not bad, not great. Where you can get more aggressive is if you say, well, 7,000 was the 50% retracement of the recent move. And if I sell that 7,000 put, so basically what I'm doing, and this is not necessarily true for the Deribit cash settled options, and I'll get to Ledger X in a minute. But what you can do is you can say, look, for a whole BTC, if I'm going to leverage $7,000 and commit to buying a BTC down there, I'm going to get paid somewhere around $500 for that. And that, folks, is about a 7% return. So if the price does come down to 7,000 and then bounces from there, your obligation's released, you keep the $500 and then do it again on the next bounce. Or if the price dips below that level, what they'll do is they'll just take the difference between what you originally collected in terms of credit versus the loss between whatever the price settles at versus the $7,000. So again, this is opposite because the numbers go up here. Okay, so work with me on this. But if this is 7,000 and maybe it settles on 26th of June down at 6,500, you know, that's basically a break-even trade at that point because you originally collected 500. They're going to remove the 500 from this. And again, that is based on you selling an entire full BTC of contract size. It doesn't need to be that way. Now, my preference with doing this type of trade is not to use the cash settled type of arrangement. It is more to use physical settlement, which is what's available through Ledger X. Here's the Ledger X interface. Now, this is dramatically more simplified. This is a very simple interface. They don't do much of anything. But basically, when you say that you're going to sell this $7,000 put, what you're going to do is negotiate your credit between the natural bid, which is 223, and the natural offer, which is about 500. So it's going to be somewhere in the middle of that, which is going to be somewhere in the 300, 350 range. So a little bit less credit for this. So this is, you're again looking for maybe about a 5% return at these rates. But what's interesting here is a couple of things. First of all, this is physically settled. If the price, if you sell that $7,000 put, so there's the 7K, and you sell this put for, let's just say 350. That 350 goes right into your account, never goes out again, goes right into your account from selling that put. So the price is up here. Now, if it does come all the way down by expiration date, let's represent expiration date here. If it does come all the way down to here and then through the $7,000 level, you get assigned if it's still there by expiration date. Doesn't happen early, only by expiration date. And then you get the asset. Well, basically what you just did was you got paid to buy Bitcoin at a pullback. So instead of having a limit order down here at $7,000 and taking a limit order entry for that spot or for the leverage contract that you would buy, you just got paid for that. So your cost basis is actually well below that $7,000 level. So for a full BTC, it would be $6,650. not bad. And also what I think is cool about this is that, again, you don't have to be right. You don't have to be right with this in terms of your direction. You can be, if you're entering up here, if the price goes sideways, you win. You still keep the 350. If the price goes up from here, you win. You get to keep the 350. If it goes down from here, you win. You get to keep the 350. It's only when it goes dramatically below 7,000 that your trade is temporarily underwater. And yes, you do get to buy it at 7,000 and not what the price is at that particular time on that expiration date. So that's the risk, is that you've got some downside risk to this, which is why I will only do this on assets that I want to purchase. And so this, to me, is just a much smarter way to do dollar cost averaging, getting paid to do dollar cost averaging by selling puts that are out of the money. Now, here's the other thing that I want to bring to your attention is the minimum trade size is one contract. And here's the good news, is that one contract is 1/100th of a BTC. So if you sell one contract at $7,000, what this does is obligates you to have $70 of capital to buy that. So this can be done with very small accounts as well too. Normally this strategy is really only for larger, medium-sized to larger accounts for the cash secured put strategy. But now the way that LedgerX has done this, and LedgerX obviously is open to US citizens. I don't know whom else that they're taking business from, but it may be worth your time to check into this. But 100 BTC contracts, 1 BTC, right? So 0.01 BTC is the minimum contract size. Now, last thing I want to discuss here is that make sure that you negotiate this. Make sure you negotiate somewhere in the middle between these two. Never take the natural bid if you're selling these things. You lose a tremendous amount of edge to the market maker in that case, or any virtual market maker that's sitting on that spot, buying at 221 and selling at 498. They'll sit there and do that all day long if you allow them to do that. So make sure you negotiate in between the bid and the offer for any options. Okay, so back to the chart. We may have some volatility in the near term because of the FOMO into the halving. So what the market may do, those that have the means at their disposal may chuck off everybody, all the weekends that bought in above 9,000. That's going to be their goal, is to convert everybody into a bear in the short term. And then what they're going to do is then once everybody is convinced that the market is heading lower, that this is just a failed breakout, they will take everybody long and stop out everybody that just went short. That's their job. That's the goal. Markets move in the direction of the fear. You can either complain about these whales and the speculation, or you can get on the side of them, which is usually the opposite side of linear logic. And it's called a contrarian read on the market. I'm not going to bother going through any of the other assets. Everything is pretty much showing the same exact type of pattern. Again, this is still a strong swing to the upside on the weekly chart. That has not changed yet. We have not changed the polarity, but you have to understand the polarity is still to the downside for many of these longer term trends. So it's only when we put in that higher low on the weekly chart and pivot from that point and start to really crush the shorts, that is when we're going to escape from this 2-year-long bear. And it will be dramatic when it does happen. Be patient for it. It will come. Thanks for listening today, guys. Have a great weekend. Happy Mother's Day again. I'll see you back here on Monday.